How to invest $500 to $1,000. You're ready to start investing, but you might only have a small amount of money. That's why I want to address how to start investing if you only have $500 to $1,000. This is an interesting topic because I'm going to be making a lot of assumptions. If you have $500 to invest, which is a good amount of capital, but it's still a low amount of capital if you look at the long term of your investing journey because eventually you will want to invest more than $500. But if you have $500 to $1,000, what I want you to take away is the thought process and the mindset. Your situation is more than likely different. So you might have less than $500 to invest. You might only have $300, or you might have more than $1,000 to invest. You might have $5,000 or even $10,000. When I started out, I had between $5,000 to $10,000 of capital to invest. You can take this information and then apply it to your own situation and start building your own wealth. Some of the topics that I will mention are going to be stocks, ETFs, and bonds. I'm going to skip the index funds because with the more popular index funds, you're going to have to put down a large amount of capital just to start investing in them. For example, if you take the popular Vanguard S&P 500 index fund, which is the VFINX, the minimum amount is $3,000 to start investing in that fund. So that's why we will leave the index funds on the side for now and focus on their ETF equivalent. I'm also going to look at aggressive and conservative portfolios. $500 investment portfolios. The first one we will look at is the aggressive $5,000 portfolio. Now, when I say aggressive, I'm talking about how risky and how risk averse you are when it comes to investing, because the riskier investments are going to be stocks, fixed income assets such as bonds are going to bring stability to your portfolio. In a bull market, everything is looking great. Stocks are shooting up, but in a bear market, stocks are dipping down, and your bond, your fixed income asset, will provide stability to your portfolio. The first thing that you want to pay attention to when it comes to your $500 aggressive portfolio is the VOO ETF, which is the Vanguard 500 Index Fund ETF. You want to buy one share of this ETF. Currently, it's priced at $366. The next one you want to look at is the VXUS, which currently is only about $52. You only want to buy one share of that ETF as well. The VXUS is the Vanguard Total International Stock Index Fund ETF. And since this is a total international ETF, you're also capturing high-quality companies outside of the U.S. The last ETF that you want to have in your $500 aggressive portfolio is the BND ETF, which stands for the Vanguard Total Bond Market Index Fund ETF. So we have $360 for VOO and $52 for VXUS, which is the International Stock Index Fund ETF. And then you have $72 for BND. If you break it out by how risky your portfolio is, your fixed income assets, which is the BND, accounts for 15% of your portfolio. Now, the other 85% consists of stocks, both the S&P 500 stocks and then also international stocks. So with the S&P 500 ETF and then also the VXUS, which is the total international ETF, you have that immediate diversification in high-quality companies. And then with the BND, you have that fixed income asset that provides stability to your portfolio. This is a very aggressive portfolio because only 15% of your portfolio is in a stable fixed income asset. If you add up all these three ETFs, you'll pay about $490. So you still have $10 left to buy a fraction of a share, or you can also invest it in crypto. If you move over to the conservative $500 portfolio, we're going to make some slight changes. We're going to keep the VOO, That's the foundation of your portfolio. And we're going to buy 2 BND shares, which will bring your fixed income assets to 28% and your stocks to 72%. If you add this all up, you'll get a little over $500. You'll get to $510. The reason why this is more on the conservative side is that you have 28% of your portfolio in a fixed income asset. The way I think about fixed income assets and asset allocation is to use the John Bogle method. This method says that whatever your age is should be your percentage in fixed income assets, such as bonds, certificates of deposits, savings accounts, etc. So when we look at bonds, I'm going to take 30 years as the average. I'm just assuming that we are all 30 years old now. Depending on how risk averse or how risky you want to get with your investing, you don't have to put 30% in bonds. You can go even less or even a little bit more. So let's say you are 30 years old, but you only want to have 20% in fixed income assets. Just tailor your portfolio to hit that correct percentage. $1,000 investment portfolios. You have probably already noticed with the conservative portfolio, we got rid of the total international ETF. If we now move over to the aggressive $1,000 portfolio, now it gets a little bit more fun and a little bit more interesting because we're going to introduce some individual stocks. We're still going to keep the same ETFs, but we're going to add some additional stocks to it. Also, I want you to add 2 growth stocks and 2 dividend-paying stocks of your choosing, but make sure you still hit that $1,000. It's fine to go slightly over or slightly under, but try to keep it in the $1,000 range. We have VOO, which is the foundation of the portfolio. We have one for VXUS, which is the International Stock ETF. We have 2 BND. We have 1 Tesla, which is a growth stock. We have 1 Amazon stock, also a growth stock. And then we have 2 dividend-paying stocks. The first one is Realty Income, and the second one is Nike. Looking at the cost, VOO is $366, VXUS at $52, BND, since we have 2 at $144, Tesla at $194 currently, Amazon at $99, Realty Income at $64, and Nike at $105. If you add all these up, you're a little bit over $1,000. You are at $1,024. These are the 2 individual dividend-paying stocks and growth stocks that I choose. You can switch them out and pick your favorites with this aggressive $1,000 portfolio. Also, similar to the aggressive $500 portfolio, with the aggressive one, we have 14% in fixed income assets because we bought the BND ETF. Moving over to the more conservative $1,000 portfolio, we're going to keep the same stocks and ETFs, but we're going to make some slight changes. What I'm going to do is we're only going to have 1 growth stock and 1 dividend-paying stock, and we're going to go up on our fixed income asset because we want to get it into that 30% range based on our imaginary age of 30 years old. We're still going to keep VOO, which is $366. For VXUS, we're going to keep 1. We're going to up BND from 2 to 4 shares. I'll keep Tesla, and I'm keeping Realty Income. Realty Income is a monthly dividend-paying stock, so you'll have the benefit of seeing monthly dividend payments from this real estate investment trust deposited into your account with this conservative portfolio. Your fixed income assets, your bonds, are at 30%, and then 70% are in stocks with this asset-allocated conservative portfolio. If you add up all your capital, you will spend about $964 in this portfolio. So you still have a little bit of legroom. You still have a couple of dollars to invest in a different security with the portfolios that I've just talked about, You can take both the aggressive and the conservative and then apply them to your own situation. You might want to fudge some of the numbers a little bit, maybe switch out a stock here or there and then make it your own. If you have more than $1,000 to invest, you can just adjust the aggressive or conservative portfolio based on your asset allocation. Opening a brokerage account. You might be ready to start investing, but you have no idea where to start. Nowadays, it's extremely easy to start investing because all you need is a brokerage account. Some of the more popular ones are going to be Robinhood, Ally, TD Ameritrade, and E-Trade. You have a plethora of options. All you do is go to the particular brokerage firm's website, fill out your personal information, get your login info, deposit your capital, and you're ready to go. Make sure that you only invest when you're starting out during business hours. Don't trade during the after hours, either pre-market or after the market closes, because that's another level of risk that if you're just starting out investing, you don't want to mess with. Another cool thing about brokerage firms nowadays is that you don't have to pay commission fees when you buy or sell shares. Back when I first started out investing, I had to pay $5.99 to $6.95 just to buy and sell stocks. But nowadays, brokerage firms have different ways to make money, such as order routing, which allows them to give you commission-free trading. And even if you have less than $500 to invest, you might only have $100 to invest. Still, go ahead and start investing because you can buy fractional shares. So you don't even need to worry about buying a whole share. You can buy a fractional share of, let's say, a company such as Apple or even Amazon. If a company pays a dividend, if you buy a fraction of that share, you also get a fraction of that dividend. So even if you only have $50 to $100 and you want to invest in Coke, but you think that you don't have enough money, go ahead and buy the fractional share, and then you also get that fractional dividend. The next thing you will notice about investing with a low amount of capital is that emotionally, you'll be able to handle the ups and downs of the stock market better because you only have a small amount of capital invested. You're going to be less inclined to make immediate decisions when it comes to selling stock when you see the value of your stock dip down. Now, what's not going to happen with only $500 to $1,000 is that you're not going to become a millionaire overnight. You have to be realistic when it comes to investing a small amount of capital. There are stories out there where somebody had only $10,000 to invest. They started investing in penny stocks or they started doing some day trading and they became millionaires. You have to be skeptical when you hear those stories. Is it possible? Yes. Is it probable? No. It's best to look at investing as a long-term journey. So you start out with a small amount of capital, which might be $100, $500, or even $1,000. You invest your capital, you learn the process of investing, and then you just add more capital to invest on a frequent basis, also called dollar cost averaging. But that's how you want to approach investing. Don't look at it as a get-rich-quick scheme. Look at it as you're building your wealth over the long term. And when you're starting out with a small amount of capital, you'll be able to go through the ups and downs because it's fine to make many mistakes. Everybody makes mistakes, even myself. Every now and then I might buy a stock that ends up being a dud. But since I'm diversified, I have my capital in multiple securities. Even if I take one hit overall, I'm still sleeping fine. You might also be thinking, you know what? Forget the stock market. I'll take my $500 to $1,000 and I'll invest it in the crypto market. I'm the type of person to tell you, yes, go ahead and do it, but make sure you take calculated risks. Even myself, I'm also invested in the crypto market. What I would recommend is that you have a separate budget for the crypto market. Make sure you invest in the stock market, but then if you want to, you can also invest in the crypto market. Just keep in mind that the crypto market is also a lot more speculative than the stock market because even if you look at the stock market when it comes to some of the companies that we invest in, The price of the stock should be based on the earnings of a company and how well the company is performing. But when it comes to the crypto market, there are no underlying metrics that you can analyze to figure out how much a crypto is actually worth. So it's all based on speculation. If you end up investing your first $500 to $1,000, make sure you give yourself a pat on the back because this is a big deal. You might not look at it like that. You might think that, oh, I'm only investing a small amount of capital. But don't look at it like that because it's a mindset shift. You're doing something totally new. You're starting to invest in the stock market, and you might like it so much that you get addicted to it in a good way, that you will try to find other ways and other methods of generating some capital in order to invest in the stock market and start to get rich. 5 best dividend stocks. Dividend stocks are exciting to me because this is where I shine when it comes to investing. There's nothing more interesting and exciting to me than buying a company that pays dividends when it's selling at a discount and then just holding on to it. And while you're holding on to it, you're making passive income or residual income in the form of a dividend every quarter or every month, depending on which company you buy. But because you also bought it at a discount, you also have the possibility of seeing some capital gains. So it's a win-win situation for me. It's also more of a set it and forget it method. You buy it once. If you do the research, you want to buy good companies, of course, and then you just hold on to it and enjoy the passive income that you generate. Not only do I look at dividend income as a passive way of making money, it's also a way of making money that grows faster than inflation because a lot of companies don't only pay a dividend, they also grow their dividend. Some companies might also pay a special dividend every now and then, so it's a very hands off way of investing. It allows me to sleep well at night, so even if the stock market is trending down, I don't lose any sleep because I'm still holding on to my dividend paying stocks because they still pay me a dividend that increases faster than inflation. I reinvest that dividend to get more dividend income, and when I'm holding on to the stock, the price still has the potential to bounce back, and I can see my capital gains rise up. Dividend investing might not be a fast way of making money, but it's a stable and consistent way of not only making money but also building wealth. I can plot my dividend income, for example, in an Excel spreadsheet and track how much money I'm potentially going to make year after year, depending on how much I invest in dividend paying companies. This is not something that I can do as efficiently by just looking at capital gains because with capital gains, the stock price or your investments are going to fluctuate year over year. So you might see that in one year, your investments grow by 9%, but the next year your stocks might have actually lost and dipped down in value. The first dividend paying company is Nike. Now, Nike is famous for their footwear, of course. That's how Phil Knight started the company, by selling shoes. But Nike is known for more than just their shoes. They also sell fitness clothes, and when it comes to endorsements, Nike has partnered with the best athletes in their respective sports. Athletes such as LeBron James, Michael Jordan, Rafael Nadal, Tiger Woods, and the list goes on. Whenever any of these athletes wear Nike clothing, it brings their fans to Nike. And of course, it brings visibility to Nike. The 3 main brands that Nike owns are going to be Nike, Jordan, and Converse. From a dividend perspective, Nike has paid a continuous dividend since 1997. That's more than 20 years. They grow their dividend. If you look at the 5 to 10-year average by 11%, and their payout ratio is at 35%. The payout ratio explained in simple terms. You can take the net income that a company generates, and a portion of that net income is paid out as a dividend to the shareholders. For Nike, it's 35%. I like it at 35% because a company that has a higher payout ratio, let's say 90%, if it has a bad year when it comes to their net profit or net loss, it might not be able to pay out a dividend. So having that cushion of 65% because they only pay 35% out as a dividend is what I like because they have a cushion where they can still raise the dividend and not be in any financial problems. Also, a fun way of looking at this company is whenever you own Nike shares, if you see somebody walking around outside in Air Jordan shoes or even Nike clothing, a portion of that sale is going to come to you as a dividend because you're a shareholder. AbbVie Inc. The second company on the list is AbbVie. Now, AbbVie is a healthcare sector. It's a biopharmaceutical company. In layman's terms, they create medicine to try to get rid of illness. It's a $255 billion company, and this is actually a spin-off because in 2013, they spun off Abbott Laboratories. From a dividend perspective, this company has paid an increasing dividend since 2013, and they've been able to grow their dividend by 20% on average year over year since 2013. From a payout ratio standpoint, their payout ratio is higher than what we saw with Nike. Their payout ratio is at 74%, but they've been able to consistently generate revenue, and they've been able to grow their revenue between 11 to 15%, which also means that they've been able to grow their dividend. Microsoft Corporation. Number 3 on the list is Microsoft. The funny thing about Microsoft is that most people don't focus on Microsoft compared to other companies. Companies that you always hear about are going to be your Teslas, Google, Facebook, and even Apple. But Microsoft is a $1.6 trillion company. One thing that's interesting about Microsoft is that they have their hands in so many different business ventures, not something that I necessarily like, but it works for Microsoft. They have Windows, GitHub, Xbox, Azure, which is a competitor of AWS, which is a technology infrastructure. Microsoft is doing extremely well, and from a dividend perspective, this company has paid a continuous dividend since 2003. They've been able to grow their dividend on average by 11% year over year, and their payout ratio is at 25%. So everything is pretty much up and up for Microsoft. PepsiCo Inc. Number 4 on the list is PepsiCo. The Pepsi Company is a $244 billion company. What I like about this company is that it's extremely easy to explain what they do, even to a little kid, because Pepsi produces beverage drinks. But that's not the only thing that Pepsi does. Pepsi owns a slew of brands such as Gatorade, Lay's potato chips, Doritos, Quaker Oats, and the list goes on. From a dividend perspective, PepsiCo has paid a continuous dividend since 1973. That's almost 50 continuous years. And not only have they been able to pay a continuous dividend since 1973, they've also been able to grow their dividend. If you look at the last 5 to 10 years, by around 6%. Their payout ratio is a little bit higher at 64%. But with the track record of Pepsi Company paying out an increasing dividend, they've been through so many economic bumps. Think about the Great Recession and the Y2K crash. Even through all those dips in the stock market, the Pepsi Company has been able to still pay a dividend and increase its dividend above the average inflation rate. That's why I like the Pepsi Company, and I have them on my watch list. I also bought stock in the company. Unilever Pick. And for number 5, I want to throw in a different company, a company outside of the U.S., because number 1 through 4 were U.S. companies. This one is outside of the U.S. It sells famous products also, and it's the Unilever Company. The Unilever Company is a British consumer goods company, so this is a UK-owned company. You know some of the brands that they own, you've heard of them, but you never thought they were owned by Unilever. These brands are going to be Ben & Jerry's, Dove, Hellmann's. Think about the mayo. From an investing standpoint, there's something interesting about companies that are outside of the U.S. Now, some of these companies still pay increasing dividends, but you will notice that the dividend amount that is paid out is not consistent because it goes up and down. But if you look at a long term dividend amount trend, you'll see the trend be an upward trend. Unilever has paid a consistent dividend since 2008, and they've been able to grow their dividend by around 6%. Their payout ratio is kept at around 64%. So, all in all, Unilever is one that you need to have on your watch list and buy when it's trading at a discount. American Depository Receipts. ADR stands for American Depository Receipt. If you want to invest in a company outside of the U.S., just keep in mind that not all great companies are just within the U.S. Outside the U.S., there are also companies that you might want in your portfolio. For example, Unilever. If a company wants to go public and be traded on a stock exchange, it usually does that within the country that it's in. So in the US, for example, we have the NASDAQ and the New York Stock Exchange. If you go overseas, let's say London, you have the London Stock Exchange. If you look at Amsterdam, you have the Euronext Amsterdam Stock Exchange, and the list goes on. Most countries have a stock exchange unless they're small and they don't participate in the buying and selling of securities. Most companies are not going to go through the hassle of being listed on different stock exchanges in all these countries. So a company in Brazil is probably going to be listed on the Brazilian Stock Exchange, but they're not going to do the due diligence to also be listed on the American stock exchanges and the London Stock Exchange. An ADR then allows you to buy stock in companies that are not in your current country's stock exchanges. So in the case of Unilever, the ticker symbol being UL, you can buy Unilever on the New York Stock Exchange. We went over a lot of good information on these dividend-paying companies, but you still want to make sure that you buy them when they're selling at a discount, because as a value investor, you don't want to buy something when it's too expensive. So, a good way of seeing how expensive or cheap a company is by looking at the price to earnings ratio, the PE ratio. With dividend paying companies, I like to see a PE ratio of 15 or less. You can also stick with 20 or less, however, I prefer 15 or less. Investing in dividend paying companies is a steady way of building your wealth over time. It's not a fast method that you can see with growth stocks, but with dividend companies, I can plot my dividend income into the future. I cannot do that with growth stocks because they're a lot more volatile. But with dividend paying companies, I pay attention to the price of the stock, but I also definitely pay attention to the dividend income that I get. And I make sure that whenever I get the dividend income, I invest it back in companies that can grow their dividend. I take that dividend income and reinvest it into the company, or I take it and I invest it into different companies that pay a dividend. I also take my new capital and invest it in dividend-paying companies that continue to increase their dividend payments. And then some of these dividend-paying companies also pay a special dividend every now and then. So it's a snowball effect. 4 best dividend index ETF funds. Let's talk about 4 awesome dividend ETFs and some index funds. I call dividend ETFs autopilot passive income because all you have to do is invest a little bit of money and you're collecting dividends on a frequent basis. And the best part is that you don't have to do anything for it. It's extremely passive. Another benefit is that you are immediately diversified into different dividend-paying companies that you're getting your income from. You don't have to go out there and do the fundamental analysis to make sure that you're picking and choosing the correct dividend stocks to purchase to get that dividend income. Also, the fund managers of these dividend index funds and dividend ETFs are managing this dividend ETF and making sure that they're buying and selling the right dividend stocks for that portfolio. All this is a big benefit. I'm a value investor, which means that I like to analyze companies, add them to my watch list, and buy them at the right moment. But even I see the benefit of having dividend ETFs because it's not only about buying these companies, it's also about managing them, maintaining them, and making sure that the companies that you bought are still good enough to be in your investment portfolio. And if you're the type of investor that does not have a lot of knowledge or time to analyze individual stocks, a dividend ETF or index fund is the right way to go. Now, can you get rich off of dividend ETFs? You definitely can. It's more of a slow process because with the dividend ETF, the price of your ETF is going to fluctuate, but your dividend income, you will get that on a frequent basis. It's more of a slow and steady way of building your wealth, but it's more stable and it's more consistent. It's something you can rely on. If you're just starting out investing and you're really interested in how dividends work, then that's the best place to start. Start out with a dividend ETF, see what type of companies are in your dividend ETF, and then you can take it from there. If you want to take the next step and then invest in individual companies, you have a good baseline to start with just by looking at some of the companies that you are invested in the dividend ETF. For this hands-off approach, you'll have to pay a fee which is called the expense ratio, but the expense ratio is so low, it's worth it. It's worth it to just invest in a dividend ETF compared to using your free time to start analyzing companies. If you're just starting out, you're not even sure and you're not even confident in what you're investing in. At least with a dividend ETF, yes, you're paying the expense ratio fee, but you know that you're investing in the right type of fund. Vanguard Dividend Appreciation ETF. Looking at the first ETF, this one is going to be the VIG, which is the Vanguard Dividend Appreciation ETF. If you're looking for the index fund equivalent, you want to go with the VDADX, which is the Vanguard Dividend Appreciation Index Fund, Admiral shares. Now, with this ETF, 97 to 98% of it is invested in U.S. equity, which means U.S. companies, all large cap companies. Out of those large cap companies, 20% of those are invested in the financial sector, and the top three companies are United Health Group, Johnson & Johnson, and Microsoft. This fund has an average 2% when it comes to the dividend yield. Dividend yield, explained in simple terms, means how much dividend you are getting for the price that you're paying. So if you paid $100 for an ETF and the dividend yield is 2%, you'll get 2% in dividend income. The expense ratio is extremely low for the dividend ETF at 0.06%. And going back to the dividend yield, don't look at a lower dividend yield of, let's say, 2% as a bad thing, because with that dividend yield of 2%, whenever you get your dividend, you're actually reinvesting that dividend to buy more dividend-paying companies, in this case by reinvesting the dividend back in the fund. So in this case, that 2% allows you to compound your money. Schwab U.S. Dividend Equity ETF. Number 2 is the Schwab U.S. Dividend Equity ETF, also found under the ticker symbol SCHD. Now, with this particular ETF, 99% of the capital is invested in U.S. equity. All large cap companies, with the highest percentage being in the financial sector, which is 21%. And then the top 3 companies are Merck & Company, Amgen, and IBM. This ETF also has a very low expense ratio of 0.06%, and then the dividend yield is a little bit higher at 3%. So SCHD is a must-have in your investment portfolio. Vanguard High Dividend Yield ETF. Number 3 is the Vanguard High Dividend Yield ETF, which you can find under the ticker symbol for VYM. And then if you're looking for the index fund equivalent, that's going to be VHYAX, which is the Vanguard High Yield Dividend Index Fund Admiral. Now, with this ETF, 97% to 98% are invested in U.S. equity, also large cap companies. But the top three sectors in this case are going to be financials, consumer staples, and healthcare. And then the top three companies in this ETF are ExxonMobil, Johnson & Johnson, and JP Morgan. This ETF also has a very low expense ratio of 0.06%, and then the dividend yield on this one is also 3%. Vanguard Real Estate ETF. And number 4 is the highest dividend yielding one, which is the VNQ, which is Vanguard Real Estate ETF. Now, in the real estate sector, you will always have a higher dividend because REITs pay a higher amount of their profits out as a dividend. With this particular ETF, 99% to 100% are invested in U.S. equity, mostly mid-cap companies. And then this ETF does have a little bit of a higher expense ratio at 0.12%, but not that high compared to what you will see when you look at mutual funds. This ETF is 100%, of course, invested in the real estate sector. And then the top three companies are Prologis, American Tower, and Crown Castle Company. Another great benefit that you have with investing in dividend ETFs compared to a growth ETF is what's happening in the stock market. Because if you think about the bull and bear market, a bull market is whenever the stock market, on average, is trending up, we're in a bull market. But a bear market is the opposite. So whenever the stock market is trending down, we're in a bear market. Whenever the economy is in an uptrend, people are more optimistic, and they spend more money on consumer goods and services. They also spend more money on buying investments, so the stock market is going to rise. But in a bear market, people are pessimistic. The economy might not be doing too well. We see sky-high inflation, so people might panic and sell their stock. They might sell their shares, and they might even sell their ETFs. So by investing in a dividend ETF, those can weather the storm better compared to other types of ETFs, such as growth stock ETFs. Dollar cost averaging. The easiest way of looking at dividend ETF investing is by also thinking about dollar cost averaging. With dollar cost averaging, you're investing a specific amount of money on a frequent basis. For example, you might be investing $100 a week, or you might be investing $100 every month. With dollar cost averaging, you're allowing yourself to buy stocks, or in this case, ETFs or index funds. It doesn't matter if the price of the ETF is up or down. It always averages out because you're adding more money to your ETF when the stock market is in a bull market, but also when it's in a bear market. That means you're averaging it out. It's a way of investing without being emotional about investing. You're taking your emotions out of investing because, more than likely, if the stock market is crashing or we are in a downturn or an economic recession, you're less likely to invest. But with dollar cost averaging, you're allowing yourself to invest when stocks and even dividend ETFs or dividend index funds are selling at a discount. So you're buying them when they're cheap. Dogs of the Dow. Looking at these dividend ETFs and even thinking about dividend-paying companies, if you want to find good individual stocks, there are a few different methods that you can use. One of those methods is the Dogs of the Dow method at buying dividend-paying companies. With this method, if you look at the Dow Jones Industrial Average, which consists of 30 high-quality blue-chip companies, a blue-chip company is a stable company that is a leader in the market. It has a track record of success, and it's a large-cap company or even a mega-cap company. The Dow consists of 30 high-quality dividend-paying companies. What you do with this method is you take 10 companies out of the 30 that have the highest dividend yield, and you buy them at the beginning of the year. You wait a whole year, and then you apply the same method. Now, the reason why you want to take the 10 highest yielding dividend-paying companies is because the index of the Dow already has 30 high quality companies. And if a company has a high dividend yield, that means that the share price is low compared to the dividend yield, which means that in the future, potentially, the price of the stock is going to go up anyway. So you're having a double effect of collecting the dividend, but also waiting for the share price to potentially go up. Dividend lists. Another method that a lot of dividend investors like to use is to look at a specific list, such as the dividend kings, the dividend aristocrats, the dividend champions, or the dividend achievers. These are lists of dividend-paying companies that have paid a continuous dividend in the last 10, 25, or even 50 years. So the Dividend Kings is a list of companies that have paid a continuous dividend for 50 plus years. The Dividend Achievers is a list of companies that have paid a dividend for at least 10 years. One thing to pay attention to, though, even if you look at these lists with companies that have paid a continuous dividend, you want to make sure that on a yearly basis, the dividend growth has been higher than inflation. So to me, it doesn't matter if a company has been paying out a dividend for 25 years. If they don't increase their dividend on a yearly basis faster than inflation, then that's not a company that I want to invest in. Dividend ETF versus dividend stocks. So why go for an ETF versus an individual stock? Now, you can still do both. You don't have to pick and choose one or the other. But with the ETF, like I already mentioned, you have immediate diversification. You have a fund manager or multiple fund managers that are managing that ETF compared to an individual stock where you have to go out, do the research, and do the buying and selling. You don't have that immediate diversification because it's just one company. But what I've noticed by investing in individual companies is that my dividend yield is better compared to the dividend ETFs. So if you look at the two, you just have to weigh the risks with the benefits. Now, another question that you might be thinking of is comparing a dividend ETF versus a growth stock ETF versus an S&P 500 index fund or ETF. Which one of these three should you be paying attention to? Like I always say, you don't have to pick and choose a specific one because the better portfolio would have a specific amount of money invested in each of them. If you want to make it more technical, yes, you can have those three ETFs, dividend, growth, and S&P 500, but then I'm also going to add a bond fund. So a bond ETF and an international ETF. And then you can also add some individual companies, whether they might be growth companies or dividend-paying companies into your investment portfolio. I like dividend ETFs. I'm always going to be a value investor who likes to invest in individual companies, but I see the benefit of investing in ETFs because even myself, I don't always want to analyze specific companies and then always have to manage them, making sure that they pay their dividends on time, make sure that they didn't cut or stop paying a dividend. In an index fund or an index ETF, you don't have to worry about all that management because the fund manager is being paid to manage and handle all these different issues that might pop up. For example, I invested in the Disney Corporation and a couple of other companies when they paid out a dividend. But the Disney Corporation and these other companies ended up stopping their dividend payments shortly after I invested. I was lucky enough to catch most of them at the time that they stopped their dividend payments, but some of them I didn't know about until I logged in to see if I got my dividend payment, and when I noticed that I hadn't, I then had to figure out why. With a dividend ETF, I wouldn't have to manage all this. I wouldn't have to keep up to date with all these dividend-paying companies. That's why the dividend ETFs and the dividend index funds that I mentioned are a big plus and advantage in my book. 401k versus Roth IRA versus traditional brokerage account. I've noticed that there's a lot of confusion when it comes to the different investment accounts that you have access to, and then also the different retirement accounts for your retirement. I'm particularly talking about accounts such as the 401k, the IRA, the Roth versions of those accounts, the traditional brokerage account, and then also the self employment retirement accounts. A 401k is an employer sponsored retirement account. Not all employers offer a 401k, but most of them tend to. Previously, employers offered pension plans to their employees, but they all started opting for the 401k instead. With a pension plan, managing your investments was being done for you, but with a 401k, management of this retirement account is being pushed to the employee to control all their investments. With a 401k, you have some options in different securities that you can invest in, such as mutual funds, index funds, ETFs, and even target date funds. The interesting thing about target date funds is that you have an investment that automatically rebalances itself the closer it gets to your retirement age. So if you have a target date fund that is named Target Date Fund 2050, that means that the closer we get to the year 2050, the target date fund is automatically going to rebalance itself into a more stable, more conservative investment fund. Some additional cool things about a 401k is that most companies match your 401k contribution. So you might see that the company is going to match 4% dollar for dollar. For example, if you make $50,000 as your base salary and you invest 4% of your salary into your 401k, 4% of $50,000 is $2,000. If a company matches dollar for dollar up to 4%, they'll also add an additional $2,000 to your 401k. So if you invested the first $2,000, they add a second $2,000. Now you have invested $4,000 in your retirement account. Now you might also see companies that match up to 4%, but they only do 50 cents on the dollar. So you invest a dollar and they add 50 cents up to 4%. So with that example, if you make $50,000 and you invest 4%, which is $2,000, the company will match 50 cents on your dollar. So they will match an additional $1,000. Be sure to check if your company matches at the business you work at. Even though the company matches your contribution, there's still a vesting period that you have to look at because even if a company matches you dollar for dollar or dollar to 50 cents, if you look at the fine print, you will see that you need to work at the company for a few years before you're 100% vested. It might be 4 years, it might be 5 years. Every company is a little bit different. The vesting period shows you how many years you must work at a company before the company match is 100% yours to keep. You will be limited when it comes to the different options you have to invest in with a 401k. These are always going to be limited by what the company has chosen for its employees. So you're going to have a limited amount of index funds to invest in, stocks, ETFs, or target date funds. Being limited by the number of options you have to invest in the 401k could be a good thing, but it could also be bad. For an investor like me, that's actually a bad thing because I want to be able to invest in whatever I want to invest in because I do research and analyze companies. But if you're somebody that's new to investing or you're not that well versed when it comes to the stock market, then having a smaller list of options is probably best for you because otherwise you're going to get confused when you have way too many options to choose from. Some employers also offer you a discount if you buy the company's shares. There is a limit to how much you can invest into your 401k. Currently, it's a little over $22,000. Every single year, it rises a little bit, and if you're older, you can invest some additional contribution to catch up. Currently, it's over $7,000. Some confusion happens when people talk about a traditional 401k versus a Roth 401k. Everything is the same between the two with the options you have when it comes to choosing your investments, but you are taxed differently when it comes to the traditional 401k and then the Roth 401k. The easiest way to remember this is that with a Roth 401k, you're investing with after tax dollars, and with a traditional 401k, you're investing with pre tax dollars. With a traditional 401k, when you hit retirement age and you start taking money out of your retirement account, that's when you're going to get taxed. However, with a Roth IRA, you're already taxed on the money that you've made. And then the money that's left, that's the money that you invest in your Roth IRA. When you then hit retirement age, the money that you take out of your retirement account is not taxed at that moment. Now, this could all be subject to change if the government sees fit. So, which option should you go with? The traditional 401k or the Roth 401k? The cool thing about this is that you can have both. So, you're not limited by having only one or the other. You can have both the traditional 401k and Roth 401k. But one thing to think about is if you hit that retirement age, are you planning on being in a higher tax bracket? Because keep in mind, with a traditional 401k, you get taxed when you take out your money during retirement age. So if you think that you'll be in a higher tax bracket, you might want to opt in for the Roth 401k instead. So it comes down to whatever works best for your situation at your retirement age. Even if you have both, they cannot exceed the yearly contribution limit. So if the limit is $22,500, both your traditional and Roth 401k can only add up to that amount, not taking into account the catch-up contribution. The money that you invest in your 401k, can you take it out before retirement age? The retirement age is 59 and a half. You want to be careful with taking money out of your 401k because you might get hit with a penalty. If you take money out of your 401k before retirement age, you'll have to pay taxes more than likely. And then you will also get hit with a 10% penalty. There are some situations where you can take some money out of your retirement account. For example, if you're buying your first home or if it's a medical emergency that you need to pay for, there are some exceptions where you can take money out and not be hit with a penalty. But definitely double check the most recent rules when you want to take any type of money out of your retirement account. You can also borrow some money from your 401k, but you will have to pay it back into your own 401k. Individual retirement account. The IRA is an individual retirement account. You got the traditional IRA, but then you also have the Roth IRA. Like I mentioned previously, if you look at the 401k, you are limited in what you can invest in based on options that have been chosen for you. But with the IRA and the Roth IRA, you have the whole investing world available to you. So if you open up an IRA account, you can automatically invest in all the stocks, bonds, ETF, mutual funds, index funds, and everything that's out there. That's a great benefit that the IRA has that the 401k does not have. A major limitation of the IRA compared to the 401k is that the amount that you can invest in your IRA per year is a lot lower than the 401k. Currently, it's slightly over $6,000. Even with the IRA and the 401k, you're not limited by having either or, so you can have different 401k accounts in your name. Then you can also have different IRAs, such as the Roth IRA and then the traditional IRA in your name. The thing that you need to keep in mind is that, yes, you can have a Roth IRA and even a traditional IRA, but both still need to add up to your yearly limit in how much you can invest into your IRAs. A good investor will have multiple accounts because you might max out your 401k and you might have some additional money to invest. So go ahead and open up an IRA and invest that money in your IRA, which also gives you total access to the stock market. Now, the traditional IRA versus the Roth IRA. With a traditional IRA, you invest with pre-tax money, and then with the Roth IRA, you invest with after-tax dollars. So you will not get taxed when you take money out during retirement. And then with the traditional IRA, you will get taxed at your tax bracket when you take the money out during retirement age. And then, of course, some of the same penalties that you see with the 401k also apply to your Roth IRA and your traditional IRA. So you're not supposed to take out money before retirement because you'll get hit with the penalty, and you might have to pay some additional taxes. Also, keep in mind that the IRA accounts are not employer sponsored accounts, so you're not going to get an employer match with these accounts. If you want to open up an IRA or a Roth IRA account, you will have to do that outside of work. You'll have to go to one of the big name brokers, such as Fidelity, E-Trade, Ally, TD Ameritrade, etc. One thing you need to be careful with is having way too many investment accounts and retirement accounts open. So you might work at one company and you open up a 401k and then end up moving to a different company. After a year, you open up a new 401k and then you move to a third company and you now have a third 401k. And in the meantime, you also opened up a couple of IRA accounts here and there. What you need to start doing is condensing them and making sure that you don't have too many 401ks out there because it's going to get confusing during tax time. And it's also going to be hard to keep up with having so many different retirement accounts open. If you leave a 401k account open at a previous employer, more than likely you're going to have to pay some additional management fees, and that's going to come out of your investment. So the best thing to do is to roll over your 401k, either into the new employer's 401k, or you can also roll over your 401k into your IRA, making sure it matches. So you want your traditional 401k to roll over into another traditional 401k at your new employer or a traditional IRA. Now, whatever you roll it into, make sure that it works for you because you can take your 401k and roll it over into the new company's 401k, but then you will also be limited by what the company offers. Or you can take that 401k and then roll it over into an IRA, which pretty much means you will be able to bypass that contribution limit for the IRA. And then you'll be able to invest in whatever you want to invest in. Traditional brokerage account. All this might still be a little bit confusing because you're just starting your investing journey. You have some amount of money and you just want to start investing. You don't want to know about penalties. You don't want to know about different rules. You don't want to know about rollovers. What should you do? Well, the easiest thing you can do is open a traditional brokerage account, also just called a brokerage account, with a company like Robinhood, Ally, TD Ameritrade, etc. Just open up a brokerage account and you don't have to worry about penalties, selling your stock, and then getting hit with a fee. Also, with a traditional brokerage account, you can open up a margin account. With a margin account, you're allowed to invest with borrowed money. Investing is already very risky, but then tacking on borrowed money means that you're bringing your investing risk to a new level by investing with a margin account and investing with borrowed money. If your funds don't fall below a certain level, you will not get a margin call. Whenever you get a margin call, this pretty much means that you need to get your funds back up to a specific level by either selling the investments that you own in your margin account, or you need to deposit some new capital into your margin account. Investing with a margin account should only be left for the professional investors out there. Don't start opening margin accounts if you're new to investing. Even if I think about all these different accounts, the way I would do it is if you have an employer-sponsored 401k and they offer a specific match, I would definitely start there. So make sure you are invested in your 401k and you're getting the employer match. The next thing I would do is open up an IRA and invest some additional money into my IRA or Roth IRA, which will give me the option to invest in whatever security I want to invest in. I'm not limited to investing in only specific securities like with the 401k, and then once I have that set up, I would open up a traditional brokerage account, and I would use that traditional brokerage account to experiment and have fun with investing. For example, you can open a Robinhood account, deposit some money in there, start buying shares, fractional shares, dividend paying stocks, and see how you're able to fare in the stock market and grow your wealth. If you're self employed, you also have access to similar retirement accounts. Some of these are going to be the solo 401k, the SEP, which is the simplified employee pension, the simple IRA, and then the defined benefit plan.